cases, I may actually try to push the questions to the end if it's not directly relevant to the actual material we're discussing. But I'll answer this question now. So what you're asking is about the American options and European options, and whether you can trade American options in the European market and all that. So here there you're making one mistake. If you remember what I told you earlier in the previous session, that you guys are looking at the SPY ETF, right? The chart of the ETF. Is that
Yes,
correct?
sir. Yes, sir.
Okay, good. So the mistake that you have to be careful not to make is that whenever you're talking about American, European, and Bermudan in that kind of context, you have to use the word American style, European style, okay, Bermudan style. The style is referring to the, if you remember, if you go back to your notes, the style of exercise, okay? And so, see, exercise style. So when you're referring to these words, you have to refer to the word exercise. So you should say American style, European style. You can later on make it only American or European, but initially you have to say, get used to this kind of language, because what the difference that the confusion that is being being created here is because whether you can trade American options in the European market. Here, European is being used in the geographic sense, that being in Germany or being in Italy. Am I right, Sachin? Is that the context you're using, the European sense?
Yes, sir. Yes, sir. No, so for example, if I am trading in NYSE, New York Stock Exchange, so when I trade options there, so can I use European style in New York Exchange?
Yeah. So you're asking the same thing with respect to America, and I thought you were asking with respect to whether you can trade American style in the practice.
So both thing are same. Both thing I think same. I
So
just
there again, you're making a mistake, because here you're using, in your example, you're using American in the geographical sense and European in the exercise style sense. You understand what is happening?
yes, yes.
So you should not mix it up like that. So when you're talking in a geographical sense, that's a different sense, and exercise style is a different. So the answer to your question is that essentially when you're trading on exchange traded, right? If you are trading, let's say, for instance, here we have talked about.
Sir, for example, for example, if I trade today in American market, there is in every Thursday there is exercise period every Thursday. End of the month every Thursday there is exercise period. So can we say that if we I do if let's say so nothing, sir, leave, sir. I understand what I'm asking, sir.
What happened? Okay, let's do one thing, Sachin. Let's leave this discussion to the end of the class. So
Okay, sir.
again after the end, at the end of the class, but I'll just give you a quick clarification. If this confusion can happen, but we're just clarifying this. We remember to ask your question once again at the end of the class, and I'll make sure that your doubt is clarified. But the thing that I would point out here is that this American, European, Bermudan is not referring to geographical areas, okay? Not referring to New York City or Chicago or Frankfurt or Zurich. This is referring to exercise style, and essentially exercise style is determined by the exchange. If you're trading here, if you see, options are listed as both exchange traded and OTC, okay? And in both cases in OTC market, there are conventions, okay, but you have flexibility to ask for other kinds of options. And exchange traded markets, you have very little flexibility, okay? So therefore, whatever is the rule is the rule. So in exchange traded markets, whether you're trading on the Frankfurt Stock Exchange or the New York Stock Exchange, the exchange would have already decided that certain types of options are going to be American style, and some certain types of options are going to be European style. Like in your project this time, you'll be trading exchange traded options. So therefore, in this case, since we are giving you single stocks and ETFs, they are all American style exercise, okay? So you have no choice here. because I have forced you to trade in a particular market, right? That is in the market as in the US equities, common stocks and ETFs. And in that market, those are exchange traded options, and the exchanges have determined that they are all going to be American style exercise. Okay. So in a sense, this is a good general question also. It may clarify doubts for many other people. So, and we can revisit this question at the end of the class. So these are American style. So whether something is American style or your whatever style of exercise, okay, that is determined by where you're trading. Okay. If it's exchange traded, there are rules. Here, there are conventions. But here also you have to generally follow the convention, but you have flexibility. Here, there's no flexibility in exchange traded markets. So therefore, basically, if you want to trade in a particular way, okay, you have to choose the venue which allows you to trade according to a particular exercise style. Okay. So that's basically the answer to your question. Does that clarify things, Sachin?
Yes, sir. Mostly.
So the style of exercise that is being allowed for trading, that as determined by the venue. Okay. And so therefore you have to go according to that. Okay. So we'll continue with the class. Okay. We'll continue with this. Okay. 2810. We have already covered all this. 211, we finished here. Okay. And so we had discussed the intrinsic value, ITM, and the moneyness of options. Okay. So we are going to now be starting on option sensitivities and Greeks. This is the part. So we are going through, and again, the arrangement of this material that you see here is, again, I'm using my own notes because I'm referring to the textbook in certain cases. But in certain cases, textbooks don't cover the kind of knowledge that you need to have in order to trade options, because textbooks, again, are not written by people who have actually traded options. So therefore, the actual nitty-gritty decision problems, they're not very sensitive to. So therefore, I have used my own notes. And so the arrangement of topics here, these are your topics. Okay, you can see here this topic. This is the topic here. This is another topic before that. This is another subtopic before that. So these are the topics, and I've arranged these topics in such a way that ideally, if we had more time, I would have had a slightly different sequence of topics. But in this case, it's like this because I want to quickly give you the skill set that you need to be able to do your project in a reasonable way. Okay. So that's the reason for these kind of topics being here in the particular sequence. So if you remember, Utsav was talking about, he was asking about Greeks in one of the earlier classes, right? So these are the option sensitivities, which are referred to as the Greeks. Okay, let's open the price calculator. So this is this other thing that we have to learn about a little bit. Okay, so when you look at any option pricing calculator, okay, you will see that this usually has, these are the model inputs, these are the inputs to the model, and these are the outputs. Okay, as I said, this is the main output, the call option price, and the put option is derived using put call parity, which hopefully we'll study later. And you'll see that an option model will also give you these kind of outputs. Okay, delta, gamma, vega, theta, and rho. All right. Now, what are these things? So first of all, why are these called Greeks? Because these are letters from the Greek alphabet. Okay, except for this, vega is actually not a letter from the. This is just a trivia, actually, not really important conceptual knowledge, but important to know that this vega is not a letter from the Greek alphabet. So that's why sometimes people use kappa or lambda for vega. But vega is the more commonly used term. So it's not so important to just always use letters from the Greek alphabet. What is more important is to know what industry, what terms industry uses. All right. So if you have an interview where you're talking about, where they're asking you about what did you do with respect to options. So one of the things you can mention is that we learned about the option Greeks, okay, or option sensitivities, and these are the ones. So what they might ask you, okay, what is gamma or what is Vega, so that you can talk about that, right? So this is the only one which is not a Greek letter, but this is what we will use, Vega, and the rest are Greek letters. So that's why they're called Greeks or Greek letters. Okay, so they are the sensitivities. So these are essentially, if I may not, maybe I shouldn't use calculus references, but for those who have some experience to exposure to calculus, these are the first derivatives. Okay, but let's talk in more simple, in simpler terms. Okay, where uh, this delta is referring to the sensitivity of the option price. Okay, we'll just talk with respect to the call option. The put option, the same logic applies in the reverse direction. In the sense that this is the opposite type of option. But in general, this delta here is measuring, okay, the how much the call option price will change, okay, if there is a small change in the underlying price. That's what delta is measuring. So if you see, for instance, here, there'll be some change, right? So if I change the underlying from 100, is the font big enough for you guys? Can you just see what I'm writing here? Like this one I've made from 100 to 10. Can you see that? You can see the numbers, everybody?
Yes, sir.
Okay, okay, great. So I'm now, let's say I'm making this from the underlying price. If I make it from 100 to, I make it 101, okay? Then what happens to the, unlike, if you notice the call option price is 3.019, there'll be some change in the call option price. Okay, you can see that there is a change in the call option price. Okay, so this is what delta is trying to measure at a point of time. The delta is trying to measure the extent to which, so you get a general feel of this. So you don't have to memorize this at this stage. If you do it enough times, if you read it enough times, you will find that you will eventually, it will automatically become familiar to you. You'll remember what is what. But delta refers to this, that if the underlying price changes and everything else remains the same. So this whole exercise is with respect to, if you remember in your economics, you use a term called ceteris paribus. That is other things remaining the same. So this is also done from that kind of perspective, that if I keep everything else constant, all the other inputs, if I keep them constant and I change the underlying price a little bit, then what happens to the call option price? All right, or even put option price, because even the put option also has the Greeks mentioned against it. So it will apply to both. I'm just referring to the call option for simplicity. So this is what delta is measuring. There is a small change in the underlying. What happens to the call option price? And this is trying to, at a point of time, the delta is trying to give you an indication of that, right? So it's like you're saying, it's just like, so it's nothing really new actually. It's like sensitivity analysis, which you have done in your spreadsheets. Okay, sensitivity analysis, the same kind of idea, that you're trying to see how much an output changes if you change one of the inputs a little bit. Okay, that's the idea. So delta is referring to, with respect to, and so it's all written here. It is, that's why I've written it like this. And then I think I've given you this reading also, section 11. Now pages, I know which one this may have been for the 9th edition or the 10th edition. The page number may differ a little bit. So if it doesn't match, don't get worried about that. But go by the section numbers. I have checked the section numbers. They are the same across many editions. Okay. So it is basically, HP is referring to your text, and section 11.1 is going to help you with this kind of matter. And I've given you some other links also. This is a very good website. Okay, maybe not perfectly organized, but you will not get wrong information on this website. So you can read this as well. Okay, so these are the ones. So delta is referring to underlying. So I've written it like this, and hopefully this will be sufficient. So this is basically mentioning. So maybe I should write a little bit. Talk about, just to make it clear. So these are the model inputs, okay? And the option price is obviously a model output, okay? So we can maybe write it like that. That's what is actually happening here, right? So here, when I'm saying option price, I'm referring to both calls and puts. So this is basically what I said. What it is. I'm just writing it down just to make sure that it's clear to everybody what we discussed, and is also written there in the notes. This is basically just sensitivity analysis and just trying to measure how the model outputs will change in response to a small change. Uh, Maybe I should just write option prices because we are talking about prices of both calls and puts. So model outputs, okay, will change in response to a small change in one of the model inputs. All right. So here, these are the different kinds of inputs. The delta is referring to the changes in the underlying, and and gamma is trying to mention. Gamma is trying to measure the rate of change of the delta. So in the case of gamma, the meaning is slightly different. Okay. So I should maybe make an exception because gamma is slightly different from the other Greeks, because gamma is not measuring the same thing as, okay, so let me just make all this the same type, same font, so it doesn't look bad. This is something else I would tell you guys, okay? You notice this, I don't know if you tried, this is not really related to finance, but it's an important point. So I should tell you this in case you ever do this. Some of you may start your own business, etc., and then you try to do marketing for that. You notice here what I've done is I have mixed the typeface. Here, this typeface is Meriwether. Well, this is Meriwether, but this is Arial. Okay, this is Arial, and this is all Meriwether. All right. So this is something you should never do if you're designing a poster or any kind of visual communication. You should never mix the font type. Okay, always use one font type. And there's some research that shows that Georgia is, I don't think these guys have Georgia anymore here. That's why I'm using Meriwether. But Georgia is supposed to be the most easy to read. But never, one rule I would give you, one important piece of advice I'd give you is never mix font types when you're trying to do any kind of visual communication. It makes it more difficult for the viewer. So therefore, we will go back here to everything being, that's why what I'm doing is I'm making everything Meriwether. You can play around with font size, but do not have more than one type of font in one page or one display. It will create dissonance, and it'll basically reduce the appeal of the to the viewer. All right. So these Greeks, except for gamma, okay, measure, these Greeks, except for gamma, measure the extent to which, so these are all sensitivity analysis, and I'm making an exception for gamma because gamma is strictly speaking not measuring the sensitivity to the model inputs. What gamma is actually trying to estimate is the rate of change of delta, okay? So gamma is projecting the rate of change of delta, and that's why, so that's why this is actually different. So although these are all sensitivity analysis, this is also sensitivity analysis, but slightly different type, slightly different from these, all these other factors, all these other sensitivities, the Greeks. This is trying to measure at any point of time the rate at which the delta will change, okay, as the underlying changes. So it's a slightly different kind of concept. Okay, we don't have to worry about gamma so much in our own particular trading project in this particular semester, because we are going to be trading like directional speculators in options. We are not going to be worrying about gamma so much. But gamma if you are trading options like a market maker, not a directional speculator. So as a market maker, you will be doing both what directional speculators do, plus additionally, you'll be doing certain other things. And one of the most important things is the gamma hedging, which we are not going to get into. But you should have some idea that there is this other problem that you have to deal with in option trading. So you should have some awareness of that. It's like, we are going to try and climb Mount Everest, but then you should also know that there are some other mountain peaks which we are not trying to climb. So you should have some awareness of that. So this is basically it. So we will not worry about it, but you should just remember that gamma is trying to estimate the extent to which the delta will change as the underlying changes. So it's trying to give you a kind of an early warning about how much the delta will change. So, because what it means here is that if you see here, if you go from 101 underlying price, the delta is 0.587. Okay. Now, if I change the price back to 100, the delta goes to 0.533. All right. So what the gamma is trying to measure in the previous screen is that the gamma is trying to measure how much will the delta change if the underlying changes by a little bit. Okay, so that's what gamma is trying to measure. So this is a slightly different concept, but the delta is trying to measure the change in the value of the option as for a small change in the underlying price. That's why against delta, I have written underlying. All right, so this is a Greek, and this is measuring the sensitivity to a small change in the underlying. All right, so if you see this, I think this guy has also given the, I'll just see how much he has written, and then we'll discuss a few of the other. This is a good website for other topics also. As I said, the arrangement of topics may be slightly different, and some of the taxonomy may be slightly different from what I'm using, but it's a good website. I don't know why it's not loading right now. Anyway, we'll wait for it to load. We don't have to stay there. Okay. So so gamma delta is referring to the change in the underlying. Is measuring the sensitivity of the option price to a small change in the underlying. The gamma, I've already told you what it is. It is just trying to measure. It's trying to give you a forward look at the rate of change of the delta. How will the delta change as the underlying changes? Okay. So it's like a second order kind of. For those who are familiar with calculus, it's like a second derivative kind of estimate. It's like measuring how much this will change, and this is like a first derivative kind of measure. Okay, it's like a partial. These are actually partial derivatives. For those who are familiar with calculus, I don't want to confuse you. You don't have to understand calculus to understand this. It's very simple. You just have to understand sensitivity analysis. You've got a model. It's got a bunch of inputs and it's got a couple of outputs. And these are just measuring. These are just sensitivity analysis measures, except for gamma, of course. These are just trying to measure how much will the outputs change if we change one of the inputs by a little bit. That's all it is. Trying to understand it in simple terms. I don't want to make it dependent on calculus. So another thing that you'll notice also is different from the way I teach finance compared to how it's given in most of the textbooks, is there's a lot of use of mathematics in textbooks, which according to me is not really that, it's not really useful. Even calculus is not really useful in solving any certain problems in finance. But you see, I've used some mathematics, but it's very basic algebra that we use in order to figure out position sizing and all those things. So that's another difference also. These are things which are happening because I have so many years of experience in financial markets. So that has shaped my view of what is important to learn, what things are important for finance students to learn. And many of those things differ from the views of those who write the textbooks. So now delta I've explained, gamma. The next one is vega. So vega is, we will just leave this. For some reason it's not loading. So vega is as I said, it's not a Greek letter, but this is a letter that we mostly use in industry. So vega is trying to measure the change with respect to the volatility. Okay, so this is a sensitivity analysis measure for the vol input. As you can see, the vol is one of the inputs. At this time, you don't have a very good understanding of what the vol is, but at least you know it's one of the inputs. So this, what Vega is trying to measure is how much will the option price change if you change the vol by a little bit, okay? So if we change this vol from say 25 to 26, okay, what happens to the option price? Okay, you can see the option price has changed a little bit. Okay, so this is what the Vega was trying to measure in the previous screen. It was trying to measure how much, if you change this a little bit, you hold all the others constant and you change this by a little bit, how much does this change? All right, so that's what it, and this, of course, also this one. I'm only referring to this one for discussion purposes, but the discussion applies to both. So that's what Vega is trying to measure. It's a sensitivity analysis measure that if you change this vol input a little bit, how much will the model outputs change? Okay, so this fits the definition here. These measure the extent to which the option prices model outputs will change in response to a change one of the model inputs. And these are the inputs in these cases, except for gamma, which is slightly different, as I explained. Now, Vega is measuring the sensitivity with respect to the vol input. Theta is referring with respect to time to expiration. Okay, theta is another sensitivity that you can see here. Okay, now you notice one thing, that theta is negative for both calls and puts. Okay, theta is negative for both calls and puts. So the reason that theta is negative is that because here, unlike the other inputs, now the underlying, if I change it from 100 to 101, I can do that, or I can change it to 95. All right, all these things can happen, but the time days until expiration, once you do the option, once you buy the option or once you sell the option, obviously this only goes in one direction. Okay, so if you buy an option today, which is a 30-day option, this will never go to like 35 or 30. This will never go to 37. So once you buy a 30-day option, it never goes to 37 after that. It can only go to less than 30. So that's why the theta is always negative. So this somebody has already noticed. I think Vipul was talking about this in one of his questions. That essentially what he was noticing is that the price of the option. Okay, if you have a 30-day option, let's calculate the price. Now notice I've changed the underlying. That's why the price is different. The call option price. We're just focusing on calls, but the logic applies to puts also. So the call option price is this 1.14. All right, it's a 30-day option. Now, if I change this, what Vipul was mentioning is that if I change this days of expiration till from 30, if I let's say change it to 90, okay, if I change it to 90, then it goes, the call option price will change. See, the price has changed. So that's what he was mentioning, that as you increase the days until expiration, the option price keeps on increasing. And obviously, conversely, if I change now, the option price is 3.23. If I change, so let's say I bought an option which was a 3-month option. I bought a 90-day option and I paid a price of 3.23. Now, if everything else remains the same, and then 2 months have passed, 60 days have passed, and now obviously the days to expiration is 30. Now what has happened to the price of my option? I paid 3.23, but that option is now worth only 1.14. Although I paid 3.23, a couple of months ago, but a couple of months have passed, and all these things are the same. But this has become now, obviously, this days until expiration goes in only one direction. Okay, and obviously the price has dropped. If you go back to 90, you will find that the call was 3.23 and the put was 7.24. And if you change this to 30 now, the call has gone from 3.23 to 1.14, and that has gone from 7 to 5.8. So essentially, That's why this theta is negative. Okay, because as the days until expiration, as this number goes down, the value of both calls and puts will decline. Okay, as this reduces, as this input reduces, the value of both calls and puts declines. All right, and so therefore this is written with a negative sign, because everybody knows that once you buy the option or sell the option, this input can only go in one direction. The other stuff can go up and down. After you buy the option, the underlying could go up or it could go down. The interest rates could go up or down. Dividends might change up or down. Vol might go up or down. But this thing goes only in one direction. It only goes down. That's why this has got a negative sign to it. Okay. And so this is basically what it is. All right. So this is your Vega. Vega is mentioning the change in the price of the option, which is a model output, in response to a small change in the vol input. Okay, there's one of the inputs is called vol, and if you change that input, what happens to the price of the option? The theta, sorry, I just discussed the theta. Theta is referring to the change in option prices as a function of time to expiration. If you reduce this time to expiration by a small amount, what happens to the price of the option? And in the same way, rho is referring to interest rates. Okay, so rho is a sensitivity for option price sensitivity with respect to interest rates. So here, rho is telling you, so you see it's a small value. Okay, if you change the interest rates, you'll see that even that will have an impact on the option price. I'll change it not by a small amount, but well, let's change it to 6. Even there should be an impact. You can see there is a small impact on the option prices. So if you change the interest rate, so any of the inputs, if you change, it's quite natural that the model output will change, right? So this is what rho is. Rho is measuring the sensitivity to the change in the input, that is the interest rates input in the model. So these are just sensitivity analysis, except for gamma, which is referring to the, it's a forward-looking measure of how much the delta will change if you have a small change in the underlying. So gamma is slightly different, and the rest are all sensitivity analysis kind of measures, right? I'll just mention one more thing which is important, which people might, I don't know how technical the questions will be, but they might ask you in an interview, that what is the difference between a put delta and a call delta? Now you notice that the call delta is positive, but the put delta is negative. Now why is that? Okay, remember what delta is. Delta is the change, it's the sensitivity analysis measure. I'm talking in normal terms. I'm not saying partial derivatives. If I was talking to a class of people who are all familiar with calculus, I would have used the language of calculus. But it's not necessary to use the language of calculus. We just talk about sensitivity analysis. It is trying to measure the rate of change of the option price with respect to the change in the underlying price, the small change in the underlying price. Now, here you notice something that there is a negative sign for the put option. Why is that? What that means is that as the underlying price, remember the put option is an option to sell. Okay. So you notice one thing, let me first show it to you first in terms of actual numbers, and then I'll explain the concept. So if you look at what is happening now, let's focus on the price of the put option, 5.74. Okay, if you increase the price of the underlying, okay, so now the price right now is 95. First, we make sure that the price is corresponding to this. The price is 5.74 and the underlying price is 995. Okay. Now notice what happens if I increase the option price. I'll just increase it by quite a bit so that we get a big difference and we can see the difference in the number. It's 5.74. Let's change this to 105. Okay. And what happens to 5.74? What happened to the put option? It went down, okay, in value. So this is what the minus sign means, that if the underlying, it goes in the opposite direction, okay, in the sense that it's inversely proportional. You might have remembered something from some of the other classes where you might have used terms like inversely proportional and directly proportional. So this is a similar kind of idea, that as the underlying price increased from 95 to 105, the price of the put went down. That's why the put delta is negative. What this is telling you is that if the underlying price goes up, the put price will go down. Okay, now let's do the reverse. We go from 105 in the put price. This is obvious, but I'll still do it. The put price is 107 when the underlying is 105. Now, if I change the underlying to 95, what happens to the put price? It goes up. So I made the underlying price go down, but the put price went up. So that's why this is negative, because it goes in the other direction. It's kind of like, you can say, not exactly correct to say inversely proportional, but the same kind of idea. It moves in the opposite direction. So that's why you might wonder why there is a negative sign for the put delta. And this also gives you a better understanding of what delta is, okay? Delta is trying to measure the sensitivity of the option price in response to a change in the small change in the underlying price. So why do put deltas have a negative sign? Because the put value moves in the opposite direction to the underlying. That's why. And why does that happen? Let's explain that intuitively. Why does that happen the way that I just showed you on the screen? Because remember what a put option is. A put option is an option to sell the underlying asset at the exercise price, okay? So if I have a right to sell the underlying asset, whatever it is, let's say it's a price of Microsoft stock or whatever, if I have the right to sell, if Microsoft common stock is the underlying asset, if I have the right to sell Microsoft at a price of 100, and the actual market price is 95, there's obviously some money to be made here. You can see that the intrinsic value is positive, okay? Because I can sell it at 100. I can exercise the option and sell Microsoft at 100 when the actual market price is only 95. So I can sell it, I can exercise the option. If you go back to your calculation of intrinsic value, which we discussed in the previous class, what can I do? I can exercise the option. This will also help us to revise intrinsic value. I can exercise the option. I can sell Microsoft under the option, terms of the option, by exercising it at 100. And so I will have a short position in Microsoft and Microsoft shares. And then immediately I'm going to square that short position by buying it in the market at 95. All right. So therefore, I'm making straight away a $5 profit. Okay. And that is part of that value here. And as you can remember, that means the intrinsic value of this option is $5. And therefore, this balance of 0.743, this must be equal to the time value. But if you remember what we discussed in the previous class, that is a good revision for us. Where did we write this? Definition of time value. This is already written here, actually. That's why I didn't write it. The time value is equal to option premium minus intrinsic value. Okay. So we find that the option premium is 5.743. The intrinsic value is 5. So therefore, the time value is 0.743. But what the intrinsic value, that is the most important concept, that what it is, it shows you there's a chance to make a $5 profit. So why we are trying to figure out why the put option delta is negative, or in other words, why do put option prices fall when the underlying rises, and why do they rise when the underlying falls? Because if you see, remember, we are talking about the delta, which means we are talking about sensitivity to changes in this input, the underlying price. Everything else remains the same. So if you're talking about an option which gives you the right to sell, and now we are talking about put options, the right to sell at the exercise price, and the exercise price is 100. Now, obviously, as I keep lowering the underlying price, okay, if I make it from 95 to 85, the put option will increase even more, okay? It goes to 14.6. Why? Because there's already, you can see here, there's already intrinsic value here. There's some kind of problem here because they should at least give you, there's some kind of pricing problem when you have too far out of the money, very deep in the money option. Because let me look at the vol inputs and all this, because this should be at least $15, because 85, 100 minus 85, and this is already giving you 14.61, which means the negative time value. It can't have negative. There's some kind of problem here, but you get the idea. It's almost $15. So it should give you that kind of input. The point is here that now as the underlying price drops, the put option price has increased. Why? Because you have the right to sell the underlying at a particular price, and the market for the underlying has dropped further, which means there's even more money to be made by exercising the option. It means essentially the intrinsic value of the option has gone up. That's why of the put option. So as the market price drops, the intrinsic value of a put option goes up because the exercise price is constant, because the put option is a right to sell. So I have a right to sell something at 100, and the price of that something keeps dropping. So obviously my right is becoming more and more valuable. So that's why the put option has a negative delta. As the underlying drops, the put option price goes up, which means underlying goes down and put option price goes up. That's why the sign is negative. Okay, so it's a good thing to discuss the reason why the put delta is negative, because it helps you to recap the concept of intrinsic value, okay, which is very important. As you can see here, this is for calls. This I've just extracted from that link. This is for calls, and this is for puts. Okay, you can see that intrinsic value, which is an important component of the option price. The intrinsic value for puts, strike price minus current stock price. So as the current stock price keeps dropping, and this is constant, if this keeps dropping, then this RHS of this equation becomes bigger and bigger, which is IV becomes bigger and bigger. Okay, and then the total option premium becomes bigger and bigger. So that's why the put delta is negative. Okay. So maybe I've explained it too much, but it's always good to make sure that everybody has understood. All right, so if we go back further down to where we were. So this is basically what it is, okay? Just to understand these sensitivities, and remember that the gamma is slightly different from the others, measures something else, okay? You can do your readings here, and you can talk about this, and you can read this also one, if it hopefully it opens up. But between what I've taught you and what is there in the textbook, it's enough material. So this is just extra material here if you want to read it, okay? Now, some other things that we have to know is that when you have a short position in an option, you are said to be short gamma, okay? This is something that you have to understand. This is one of the most dangerous positions you can have, because the losses actually are unlimited. The risk of losses is you can have unlimited losses. So a lot of traders don't like to have short gamma positions. So you either have, so what we have, the lingo that you have to learn is, with respect to gamma, you have to understand that if you have a short position in an option, you are short gamma. If you have a long position in an option, you are long gamma. Okay, this is the lingo that you have to learn. This stuff is important to understand. Similarly, with respect to Vega, when you have a short option, you are short Vega. And if you have a long position, you are long Vega. Okay. This is again language that you should be, and also the concept that should be clear to you, that Because what you have to understand is when you have a position in an option, when you have a position in a particular option, what does it mean because remember, anytime you have a position, whether it's an underlying asset or option or futures contract or swap, any market position that you have, okay, as market prices change, the value of your position will change. You have already seen that now firsthand. So, and it follows logically as well. And then as the market prices change, these things will tell you how much the value of your position will change. So you have a certain type of position with respect to these kind of sensitivities. You have to watch out for these things, right? So if you have a put option, if you're long a put option, and the price of the underlying keeps on rising, so the put option will keep on losing value. So you're actually on paper, you're going to be making losses. So you have to be conscious of these things. And so that's why we talk about certain types of exposures, which are very important in options. One is gamma exposure. So short long is short long gamma. Vega exposure, which is short long vega. You have to know what is short long vega, when you're short vega and when you're long vega. And then I'll come to this point here. Theta, same thing. Okay. Positive theta, short long option position has positive. So here the way I've written it is that a short option position has positive theta. Okay. It benefits from the passage of time. And a long option position has negative theta. Okay. Maybe we should actually put this in bold here. All right, positive, negative theta. So when do you have positive theta? You have that when you are short any option. Now this applies to all these statements, short gamma, long gamma, vega, short vega, long vega, negative, positive theta, negative theta. You notice that I'm only talking about short or long options. I'm not saying anything about calls or puts. That's because it applies to both calls and puts. So whether you're long a call or a put, you will be short, you will be long gamma. Whether you're short a call or a put, you will be short vega. Now you will have negative theta if you are long any option, call or put. So these statements apply. So this is something else that you need to understand. So all these points, as we are learning, I think the correct thing to do for you is to make sure that you make your own notes, okay, and keep practicing. I mean, at least once a week, do a revision, and create your own notes. That you learn it, and you learn it so well that you'll never forget it for a long time. Once you learn these things and you make your own notes, you will not forget it for a long time. These are all important things to know, and just practice it once, revise it once or twice, make your own notes, and you'll understand everything. So theta is, so this applies to both calls and puts. Okay, so all these statements apply to both calls and puts. Now, I'll just briefly explain one thing, that what does it mean to be short vega and long vega? So what that means is this. Okay, remember, I am no longer going to utter this long word implied volatility. I'm just going to say IV. Okay, actually not IV, IVOL. All right. So I'm just going to say IVOL, and so that means implied volatility. So what this means, what a short long vega position, option position which has short long vega profile. What that means is that when the eyeball rises, remember the vega is a response to the vol input, okay? And so when the eyeball rises, and we'll explain what eyeball is in the next module, the ceteris paribus, remember this expression, okay? From economics, ceteris paribus means all other things remaining the same. Option prices will rise or fall. Okay, so when IVOL rises, option prices will rise. as an example. Okay, you can check that for yourself. If the vol input rises, the option prices will rise. If you make this 30, the call option will increase, right, from 0.04 to 0.10. So this option prices has increased. So this is basically, this is what it's measuring. Okay, that a short long option, when big short long beta means that, and the consequence of being short long beta is that when the eyeball rises, the option prices will rise. When eyeball falls, the option prices will fall. So depending on whether you're short or long Vega, that will affect your position, the value of your position. Okay. So these are certain things that you have to understand, certain language and certain way of thinking about the positions with respect to the sensitivities.
Sir?
Yeah.
As you said that when the implied volatility rises, the option prices also rises. Sir, is it due to the fact that because the volatility, more volatility would mean the option could be in the money before? I mean, if it can be in the money more often if the implied volatility is more. Like if it's less, then there is less chance that then the option would be in the money.
Yeah.
Is that true?
That intuitively the way we should think about it. So what Siddharth is asking is, why is it that if we change, we bring it to a more, we bring it to at the money option. Okay, so right now, at the money call, the ball is 30. At the money call, the price is 3.62. So let the loading finish here. And yeah, so you can see here, I don't know why for some reason the website, the page is not loading fully. Yeah, okay. So at the money option, call option, price is 3.62 and the ball is 30. Now, essentially what the call option is a right to buy, right? So the if you increase the ball, the price will go up. Okay, let's say we increase it dramatically from 30 to 60, the price goes from 3.6 to 7. Why does this happen? Okay, so remember we changed only the ball input. So why does this happen? So Siddharth is correct in terms of intuitively why it's happening. So remember what an option is. An option is basically a kind of insurance product. Okay, so if what the ball is mentioning, the ball is trying to measure is how rapidly the option price, the underlying price will change in the future. Remember, this is a forward-looking estimate. Okay, so for this 30 days forward-looking estimate, for which you want a 30-day option, but it's looking forward for 30 days. So the ball is trying to measure, roughly speaking, in plain English, the ball is trying to measure how dramatically the underlying prices will change in the next 60 days. So if there is if we are expecting a lot of, dramatic changes in the option price, so the chances of this call option, the underlying price, the option expiring with as a in the money option, okay, the chances are more because there is more room for volatility. So the chances of it, and you'll notice that put option price also went up. So since basically the increase in vol is essentially increasing the probability on both sides that the option will finish in the money. That's why the call option and put option prices increase. That's why Vega is positive for both, okay? Because the increase in the volatility, which is referring to the expected future dramatic movements of the underlying price. And the more you expect the underlying price changes to be dramatic, the greater the chance that both calls and puts might finish in the money. Okay, you don't know which way it will go, but there's a chance that both of them might finish in the money. I mean, not both of them can't finish together in the money, but ex ante, when you're looking at it, it just increases the probability that either of them might finish in the money. So the person who is writing the insurance policy will charge more for it. So it's just like if you have car insurance, you might find that in a city like, of course, in India, we don't have that kind of differential pricing. But if you're looking, I'll just give you an example. If in, let's say, in Delhi, people drive much more, the driving is much more rash compared to Bombay, let's say. If you compare it to Bombay, Bombay people drive in a much more controlled fashion. So I hope I hope all the Delhiites are not offended, but this is just a fact actually. So now, if you're an insurance company and you're pricing your insurance very, very carefully, in a very fine manner, you may actually charge lower insurance premiums in Bombay than in Delhi, because in Delhi, what you know is that people drive quite rashly in Delhi. So the probability of a car accident is much higher in Delhi than in Bombay. So therefore, what you would do is your Delhi premiums, because our car insurance, like any other insurance, these are all options essentially. Okay, so and these are actually like call options. So essentially, what you have is, the option seller is going to say, well, the risk of this car insurance being exercised by the insurance buyer is much higher, so then I'll charge higher prices for this. So that's basically it. The ball higher means that there's a greater chance of these two finishing in the money, either of these, and therefore we will charge higher prices for both of them. Okay, does that answer your question, Siddharth?
Yes, sir.
Okay. So it's a very long-winded answer, but I hope I gave you some kind of idea as to why the option price, why a long option has a long vega profile. Okay, and this is basically and why this statement is true, that as the eyeball rises, the option price rises. So essentially, because options are an uncertainty, it's the short of its insurance. And the higher the uncertainty, the person who's selling the insurance, he will want to charge more for it, because there's a higher risk that he may have to pay on the insurance. Okay. So that's what it is. Now we'll try to understand what this eyeball thing is. It's very important because you will have to use it in your trading. Okay. So we have to understand this concept of eyeball. So we'll understand it at 3 different levels. First is intuitive, an intuitive level. Very simple understanding that eyeball is an indicator of cheapness, dearness of option. This dearness is not dear sir, dear madam, when you're writing a letter. No, this is dearness as in dearness allowance. You might notice that in salaries there is a figure called dearness allowance, which is a adjustment for increases in the cost of living. Okay, so this is dearness is opposite of cheap. Dear means opposite of cheap, which is expensive. This is basically this means expensive. All right. So the easiest way to understand eyeball is that it's an indicator of the cheapness and dearness of options. And once again, if I write options without any qualifier, that means that it refers to both calls and puts. Right. So the time value, we'll come to that later. But the first important understanding of eyeball is that eyeball is simply an indicator of how cheap or how expensive options in general are. So if you look at any of the eyeball charts, we have some charts here. Okay, let's go to our notes file and launch the eyeball charts. Here. So you can see in the case here for Oracle, so the common stock of Oracle, here you can see that the orange line is the IV index mean. So what this chart essentially means is that we not worry about HV is HVOL, historical volatility. We'll not worry about that at the moment, but you notice here this eyeball chart, which is going up like this, coming down, this orange line. This is meant to give you straight away for an option trader. This is a very important understanding of eyeball. The meaning of eyeball is that this is telling you that generally, in general, both for calls and puts, Okay, the option prices initially, there was a period in February, March, this February, March, where option prices in general for Oracle went up very sharply. So straight away, when you want to look at if you're trading in options of Oracle, one of the important questions you have obviously is, just like if you're trading in the ETF SPY, one of the important questions you have is, how is the market doing? How is it went up, it went down? As you can see, this actually corresponded to another thing you'll see. We'll put in Oracle here. Sorry, I missed. All right, so this is 2020. February, March here, you can see, yeah. February, March, the price dropped quite sharply. And this is the relationship we'll come to later. But this is the underlying asset price. So this is another way to understand options. This is the underlying asset price. And this is the price of the option. Okay, this is not really directly the price of the option, but as I said, IVOL is an indicator of how cheap and how expensive the options are. So all options, calls and puts for Oracle experienced a very sharp rise in Feb March in the prices of those options. And this is shown by the increase in the IVOL chart. So this chart is just a historical record of how IVOL levels, what IVOL levels were at these historical points of time. So this is just time series data. And so this is basically the understanding of IVOL, that anytime you look at, when you're trading options in any particular market, in this case, you're trading options on the common stock of Oracle. And so one of the questions you have in your mind is, okay, let's look at the history and let's have a look at how Oracle option prices have been behaving in general. So you would call up an IVOL chart like this, and you would see, okay, well, this is what happened in December, January, it was around here, then it went up like this. So this is how you use an IVOL chart. You use it as an indicator of how option prices have in general been behaving, both calls and puts. And when the IVOL chart goes up, that means the option prices became more expensive. And when it goes down, that means it became less expensive. That's how you use it. So that's your first understanding. Your first understanding of the point that we are making here. IVOL. IVOL is a very important concept to understand, and we will understand it at 3 levels. First concept is this, that very simple, that's what it is. Okay, or you can even make this even shorter. Is an indicator of the option prices. Okay, so if IVOL charts are going up, that means option prices are going up. If IVOL charts are going down, means option prices are going down. So we can even write that actually. Okay, so yeah, so option premium, this is captured here. And you can see here, this is also captured here. So option prices, option premium. So as I said here, now the time value component of option premium is affected by IVOL. What is meant by the time value component? As you remember here, that option premium have 2 components, time value and intrinsic value. Option premium consists of time value plus intrinsic value. And where the IVOL has an input is, where the IVOL has an impact is in the time value component of the option premium. All right. So because remember that the prices of options is equal to it can be split up into time value and intrinsic value. And if I'm making a statement that eyeball affects option prices, so we can write this here that we can write this here that option PV. And so if I'm saying that when the eyeball rises, the option price increases. So then you can ask a question. Well, if you see the option price increases, now we know that option price consists of intrinsic value and time value. Which component of the option price increases? So the answer to that is that it is affecting the time value component. It doesn't affect the intrinsic value component of the option price. So you can test that here. You can see that if you have an underlying price, let's say if you have let's take an out of the money call option. So if you have, let's say the underlying price is, say, let's make it 90. So if you have a 90 underlying price and the exercise price is 100, obviously there's no intrinsic value here because if I buy something by exercising the option, if I buy the underlying asset $100 and I can only sell it in the underlying market at $90, so I'm going to make a loss. So the intrinsic value here is 0. So this is the 30-day option, and this has a price of theoretical price of 2.79. Why? There is no intrinsic value in this because the intrinsic value in this option is 0. So this whole thing must be time value. Now let's increase it even further. The ball is 60. Let's make the ball even higher. Notice what happens to the option price, 2.79. Let's make it from 60 to 90. What happens to the call option? You see that the call option price goes up even more to 5.6. But what has not changed is that this call option still doesn't have any intrinsic value, because intrinsic value is a difference between these two. It's a comparison of these two. And it's a call option. So why should I buy something at 100 by exercising this call option when I can buy it in the underlying market at 90? So if I do this exercise, the two-step exercise for intrinsic value, I see that IV is actually negative, which means I have to write it as 0. So it is still an option with a 0 intrinsic value, but it's the call option premium has gone up from 2 something to 5 something. Why did that happen? Because I increased the ball input. Okay, I increased the ball input. That's why it's gone. So that's what is telling. That is what the meaning of this is. That the eyeball changes affect the time value component of the option price. So it's always useful to think of the option price as consisting of intrinsic value and time value. And so when you're thinking about some kind of input, some kind of impact on the option price, you should always try to be clear, if it is possible, to be clear about whether the impact on the option price is coming from a change in the intrinsic value or a change in the time value. Okay, it's a useful question to ask. So this is going back to Siddharth's question. If you see what happened here and what we just saw, that is an important question as to why do the option prices increase when the ball increases. So the time value actually is, you saw what happened here. The intrinsic value remains effectively 0, although actually it's negative, but we write it, when it's negative, we write it as 0. But the option price still goes up. The time value of the option price goes up. So because the volatility is, if you are now saying, you were saying it was 60, now you're saying it's 90. So the price went up because essentially these are expressed in percentage, annualized percentage figures, just like an interest rate. So now you're saying that the ball is 60%, okay? Instead of, it's 90% instead of 60%. So which means that effectively what this means actually is that when the underlying is 90, now you're saying that in 1 year, this could be like either 60% plus from 90 or 60% minus from 90. And now instead of 60% plus minus, you're saying 90% plus minus. There's a chance of that happening. So therefore, obviously, the guy who's writing the option is much more worried that it can finish in the money because the vol has been increased. So the range of movement that is possible on the underlying is much more now. It can go up, it can go down here on the left, it can go up on the right. Okay, so therefore, the guy who is writing the option is going to charge more money because the risk of the option finishing in the money has increased because you increase the vol input. So essentially what this means is like this. You can also understand a little bit about what the vol input means. That if the vol figure is 90%, okay, then what that means, and the underlying, whatever the underlying is, right now it's 90. It means that in 1 year, this underlying could finish, okay? There's like the underlying, basically this is the one standard deviation movement. That's what the vol is trying to measure. That in 1 year, this could finish at either 90% above this 90 or 90% below this 90. That's what it means. So that's the kind of, so you can see that it is an estimate of how much the underlying will move, okay, dramatically, how dramatically the underlying will move. And you have seen firsthand how as the intrinsic value remains zero effectively, but still the call option can go up if the vol input goes up because the time value is going up. And the time value is just reflecting that. The time value is reflecting the risk that a option will move into the money, right? That's what it's referring to. That effectively an option will become valuable before the expiration date. And that's what is being reflected. That's the risk that is being reflected by the this time value component of the option price, right? So IV was plus time value. And so therefore you can see that there are two, going back to this important equation, that option price equal to IV plus TV. Now what is IV, remember? IV is connected to the moneyness of options, okay, which we discussed, okay? At the money effectively means intrinsic value is zero. Here also intrinsic value is zero, all right? Out of the money, also intrinsic value is zero effectively, because but when option is not ATM. Yeah, actually mathematically intrinsic value is negative, but by convention, the way we have defined intrinsic value, if it is not greater than zero, we write it as zero, whether it's negative or actually equal to zero in this case, right? So now it's connected to this, so you can see that intrinsic value is clearly connected to the moneyness of options. When intrinsic value is zero, then the we say ATM, it's actually mathematically zero. OTM mathematically is negative, but we write it as zero. And ITM, it is actually greater than zero, the intrinsic value. All right. So what we say here is that, so and if you go back to this equation, the option price is IV plus time value. Now here's a very important way to is a useful way to understand some important dynamics of options. So that means an option price can be influenced by either this or this. Now, one of the things you have already seen is that time value is affected by the changes in the I vol. And of course, time value is also affected by the obvious things, since it's time value. Notice what happens here. Call option is 5.6 something. I'm going to change the date from 30 days to 90 days. See what happens to the call option price. It goes from 5 something to 12 something. All right, so it increases. Because obviously, if it's a 90-day option, there is more chance for in 90 days for an option to finish in the money and to become, basically valuable in that manner through the positive intrinsic value. So if you have so essentially, if you have 90-day, even though if you notice here also the call option is out of the money, so there is no intrinsic value here. Okay, you wouldn't exercise at 100 when you can buy it in the market at 90. There's no intrinsic value, but I increase the time value. I increase the days, the expiration, the tenor of the option from 60 to 90, and the call option price went up. So you can see that it is the time value is affected by the time value component of an option premium is affected by eyeball. And I'll just put in a brief here. We are not discussing this. And also by tenor. I'm just writing the American word tenor because it's a very short word. Instead of having to write days to expiration, I'm writing tenor. Okay. So obviously there are two important things that affect the time value. One is the vol input and one is the days to expiration. These two are very important. They affect the time value of the option. There's impact from other factors also, but these are the main drivers of time value. And so now you're already looking at the option price in terms of its two components, the option, the IV and the TV. Now, what affects the IV? The moneyness of the option. Okay, so this is what I'm writing here. So this is what I'm saying. The price impact on option is coming from moneyness. Okay, which is basically coming from basically the IV part of it. Maybe I should write the full intrinsic value part of it. Okay. The moneyness of the option is coming from is connected to the intrinsic value part of it, and the changes in the eyeball, which is affecting the time value part of it. So I'll just write it here. So I'm connecting. So we'll so 1 minute. Okay, I'll stop here. So once again, reminder to everybody, please revise the material we are doing on a regular basis. Make your own notes, and always remember you have to ask me questions. Okay, I find that only few people ask questions in the class. I'm sure not everybody's actually following everything, but some people are probably not asking questions. You have to ask questions because otherwise I can't figure out that you have not understood. All right, so it's your duty to ask questions. Okay, so the class is dismissed. Those who have questions can stay back, and we will also try to answer Sachin's question once again about the question that he was asking on American style, European style. So Sachin, that question, so the rest of you can leave. The class is dismissed. So Sachin, that question is clear to you regarding American style and European style? Yes, Sachin? What happened? Anyway, so then, okay, I think that we already cleared it up. Anybody else has any kind of technical question?
Yes, sir. Sir, about theta. If the change in theta is proportionate to the change in expiration date, because it is related to expiration date and time value. So if like if there is a if the expiration date is 90 option, the value for theta would be less. But if the time days until expiration becomes 2, it proportionally does it proportionally increases, or does it increases dramatically?
No, it is not proportional. It is disproportionate. So you'll see in your notes itself, there is a chart further down. We'll come to that later. I don't want to go there right now, but you'll see further down. But let's go there. Let's try to see here. Maybe, okay, I've not put the notes in here yet. But essentially, there you see here. So the answer to your question is that if you look at it like this, maybe I should increase, I'll decrease the zoom a little bit so you can see everything together. Okay, so the answer to your question is no. I mean, what you're asking is whether this line is a linear kind of relationship. Okay, the answer is no, that the theta will increase very dramatically as you become as the expiration date becomes closer to 0. All right. So when you have a longer dated option, the theta, as you go from, let's say, like 120 days to 119 days to 118 days, the change in the theta is not dramatic. But as you start, if you get very close to the to 0 days, then the changes in the theta become very dramatic. So the answer to your question is no, it's not proportional. It is disproportionate. So it's a non-linear function, okay, of the expiration date. Does that answer your question?
Yes, sir.
So this is
So
there.
you're gonna tell us that how do we use this Greek later, right, in the session?
Yeah. So I'll be telling you initially. See, you don't need to. I'm giving you all this. If you already go ahead and read the notes, you'll find a lot of instructions already there on how to use the material, how to use these concepts. But yeah, so right now what I'm teaching you is focused on what you need to know to do your project. So I'm not going to be initially teaching you. In fact, in this course, I'll not have the time to teach you that. This is going back to the question that you asked about when will we learn all this stuff, because there's so much to learn. So that question actually can't be satisfied because there is going to be material that will not be able, that we're not going to be able to cover. That's just a fact of life that we don't have the time. So I'm just trying to make sure, but even if we cover, it doesn't matter if we don't cover everything, okay, because I can give you pointers on how to cover it yourself. But as long as we cover a fair bit of material, and the more important thing for me is that because I'm finding that people are not absorbing even the material that has been taught. So that is more of a concern for me. And if we can cover, even if we can have 100% understanding of what we have covered, that itself is a huge achievement, I think. So initially what I'm covering is the material that I think you need to know in order to successfully do your project. Okay, does that answer your question, Siddharth?
Yes, sir.
Yeah. Anybody else?
Yes, yes, I have one question, sir. Uh, hello, I'm audible.
Yes.
Sir, is there any ideal ratio of reward to risk ratio which we can consider? There is any ideal ratio, reward to risk ratio, basically, which
Yeah.
we can consider?
You're talking about ideal. There is no
Right.
ideal.
Yes, sir.
The answer to your question is connected to what we have discussed here. If you notice in your when we have discussed R3. Okay, so in
Yes, sir.
to ideal, I would say there's only one way you can say there is an ideal figure, and that is that it is connected to the concept of the target return on invested capital. If you go back to our discussions in the previous course, right,
Yes, sir.
that the only way you can, so in general, I would say there is no ideal figure. It depends on what your objectives are. Okay.
Okay.
The second level answer to that question, I can say that, well, if you talk about what your objectives are, one of the important objectives that you are forced to have is that if I'm giving you money to manage, then I'm your investor. And if I'm telling you, Aman, you better produce 112.5% return, then obviously you can't ignore that because you better listen to what I'm saying because I'm financing you, right?
Yes, sir.
So therefore, that can be an important determinant of your objective. So, and what I have actually shown you in the previous, when we discussed the concept of, when we discussed this, when we were discussing the decision problem 6.1, at what point of time should I exit with my profit, to take my profit and close my position? So we were trying to discuss this, and that's when we discussed R3, right? And I said that
Yes, sir.
you can actually connect your R3 to this target return on invested capital. And I showed you how you can mechanically link this all the way down to your R3, okay, which in this case is R3 of 6, reward to risk ratio of 6, okay? So this, what I was trying to show you is that this reward to risk ratio of 6, that is, if, and which is basically flowing from given the risk per trade is flowing from at what point do you take your profit. This not to be determined arbitrarily, but it is actually it should be determined mechanically from this kind of input, because the way in which you manage your fund should be connected to, and should be determined by the way in which the person who is financing your business, the kind of returns that he wants, that should affect the way you determine your R3.
Okay, sir.
That is the only way. Does that answer your question?
Yes, sir. And sir, one thing more. Sir, what is ex-crisis style? You already told in the class, but I didn't get that much clear. So can you explain that again?
What?
Ex-crisis style. Ex-crisis style.
No, it's not ex-crisis, it's exercise.
Exercise. Oh, sorry.
When you go to the gym and exercise.
Yeah.
Okay. So exercise style is basically this concept here. Exercise style is, okay, I have to increase this. I would like to increase the Zoom a little bit since we are anyway on Zoom. Okay, this exercise style, okay, so this is very simple, just like when you go to the gym and exercise. Exercise style means there are 3 of them, and you can remember them. I mean, part of the confusion might have been because I had referred to these as 2 different continents, okay, the US and, but you can forget about that. That is basically to easily remember that Bermuda is between the US and America, between Europe and America. That's why it's Bermuda. But this is not referring to the geographic part, okay? This is not referring to the geographic part. This is referring to exercise style, which means that if you have an expiration date, let's say this way, let's put it this way. Let's say here you have a 90-day expiration, okay? Now, if this is a American style exercise, and once you buy this option with these other parameters, and it's got 90 days to expiration. Now, if you buy this, if it's an American style option, that means that so remember, the word is American style. Although in short, people will people will just say American options or European options. But we'll say when we are learning for the first time, we'll practice saying American style. So it's an American style option. That means that I can exercise this option anytime between the time I bought it and 90 days. So 90 days to go, I can exercise it on any day at any time. That's what American style means. Okay.
Okay, sir.
Connected to your the nature of your right to exercise the option. American style means you can exercise at any time. If it is European style exercise, this will all be written in the option. Just like when you buy a car or when you buy an air conditioner, that what is the Energy Star rating of the air conditioner, all that is written in the terms of the product, right? So here also the terms of the product will specify that this is American style exercise. That means you can exercise it at any point of time from the time that you buy it till the end of the option. Okay, that's American. European style means you can exercise only at the ending date. So if you buy a European style option, you can only exercise on day 90.
Okay, sir.
Right? And Bermudan is just in between the two, which means Bermudan means that if it's 90 days, it might mean something like, if you see what it says here, you can revise from your notes, okay, and also make your own notes. At Bermudan style means at multiple points of time, but not at any point of time. What that means is this. Let's say this is the Bermudan option. One way to do it in the Bermudan style is that if you buy this, maybe you can exercise once every 15 days.
Okay.
It is not as good as American style, because American style, because you can exercise any day at any point of time. But Bermudan style maybe is a little bit better than European style, because European style is you can only exercise at the end, only on day 90. But Bermudan style is not as good as American style, but not as bad as European style. So Bermudan would be, one example would be, you can exercise once every 15 days. So on day 15, day 30, day 45, day 60, and so on and so forth. But
okay, sir.
exercise on day 17. Understand what I'm saying?
Yes, sir.
So that's what it means. So there is a little bit of room for the. I had tried to explain these as because I said that okay, you see Europe on the map and you see America on the map, and then Bermuda is in between these two. So that's why they have given these names. But they, when you're talking about this with respect to options, you have to use more exercise style, and they are not referring to the geographic location. So it is not
Yes, sir.
you're trading on the Frankfurt stock or the New York Stock Exchange. That's different from this exercise style, and it is determined by the exchanges and the OTC market that you're trading. Okay, does that answer your question?
Yes, sir. Yes, sir. Yes, sir.
Okay, anybody else
Thank you,
with
sir.
a question?
Sir, everywhere it is written that options are used to hedge risk. But if we were to make and answer hedging risk would mean that the our transaction would decrease our overall risk. But sir, making money from options would mean that we would have to increase risk to make money. So isn't that contradictory?
Yeah. So wherever you read that, that statement is not correct. That's why you notice I'm very particular about how I use words. So that statement straight away is not correct. So if I say that options are used to hedge risk, okay, that means that options are only used to hedge risk because I'm not qualified in it. Okay. So that's why I tell you guys not to read here, there, and everywhere. Read only from the textbooks I'm giving you and the particular websites I'm giving you and the notes I'm giving you. Because in many cases, some of the textbooks are also wrong. Even the well-known textbooks like this one I've given you for this course, it had a mistake in one of the earlier editions. It had a couple of mistakes. This is because people are not that careful about making statements. So they don't think about the language. And so this statement is straight away not correct. So option can be used to hedge risk, but they can also be used for speculation. And if you remember, the difference between a speculator and a hedger is that the speculator will increase his risk with the first transaction, his total risk, and a hedger will reduce his total risk. So the correct statement would be that options can be used for both hedging risk and increasing and speculating. And that is true of, you normally don't use spot to hedge as such, not a good way. But generally you use most of these derivative products for hedging. So you can use futures, forwards, swaps, and options. These are just instruments, okay? And you can use them either to speculate you can use them as a directional speculator, or you can use them as a hedger. If you're using it as a hedger, you're using it to reduce risk. Okay, generally, even there, if you have dynamic risk management programs, then you can actually sometimes in one of the steps you might increase it. But in general, the idea in hedging, if you use the simpler situation of a static risk management program, the idea in hedging is always that you should try to reduce your risk, the general idea. Okay. So does that answer your question, Siddharth?
Yes, sir.
Yeah. So the statement is not correct. Yeah. Anybody else with a problem? Okay. No more technical questions. Okay. So what I'll do now, Shaurya, we have to discuss your login problem. I have still not been able to do it, unfortunately. I'll stop the recording here.